Okay, it's May 5th, and this marks the 1 month anniversary of when the inverted yield curve was spotted, and this created quite a bit of commotion, and a great deal of ink was spilled in business newspapers and magazines over it. Now, what I'd like to do is, in plain English, discuss why it is even a topic worth talking about and worthy of our consideration, and why you should probably A, not read too much into it, but at the same time, B, not sweep it under the carpet. Now, an inverted yield curve really describes a very unusual drop in yields on the long-term debt that's of the same quality as yields on short-term debt. Sometimes it's referred to as a negative yield curve. Now, the inverted curve has proven to be in the past a relatively reliable indicator of a recession, or at least an impending recession. Okay, so what is this thing? Well, a normal yield curve is when the yield or return that one would earn on a treasury increases as the bond maturity increases. That is, short-term securities earn lower rates of return, like a 3-month treasury, and as you move further and further away from 6 months, 9 months to a year, 2, 5, 10, 20, 30 year maturities, the rates of return get better. And after all, you're lending the government money for a greater length of time, and you expect to be compensated accordingly, right? So what is an inverted yield? Well, it's when that doesn't happen. In other words, in particular, the one that economists generally fix their sights on is the inversion of the yield between the 2-year treasury and the 10-year treasury. So why the worry? Well, this is the first time this has happened since 2019, and many worry that this could be a signal of an impending recession, and it may indeed be right around the corner. And after all, this is precisely what happened. So we had an inverted yield curve, and it was followed by a recession. Now, of course, the complicating factor was the pandemic, which muddies the water a bit. But the worry is not based on one data point, for sure. If one goes back many decades, economists have observed that when this happens, there's about a 2/3 chance that it will trigger a recession over the next year, and over a 90% chance that it will trigger one over the next 2 years. Now, the economics of why this might happen is fairly straightforward. Banks, like everyone else, have costs, and they want to sell above their costs. And if you look at the short-term yields as a good proxy for their costs, and the 10-year yields as a good proxy for how much they can expect to earn, this paints a bleak picture when the latter is smaller than the former. It kind of takes the whole wind out of the famous adage of buy low and sell high. If banks don't think that they can make money lending, then they'll stay on the sidelines and credit dries up. This, of course, is bad for business. So you get the idea. Now, perhaps the reason the inversion has disappeared has to do with the change in the global political climate. Perhaps a month ago, there was fear that the war in Ukraine was going to drag on into a long, protracted battle, and this scared investors, and maybe now that sentiment has changed. Honestly, I can't say anything about that. That's way above my pay grade. So I think you can make up your own mind about that. But perhaps it's because the Federal Reserve has made it clear that public enemy number one is indeed inflation. And they have, through their policies, nudged the 10-year yield back up to where it has more or less normalized the yield curve. But the other thing that is worth noting is that even though historically the inverted yield curve has done a fairly good job in anticipating recessions, it seems clear that the rules of the game have changed. The Federal Reserve now plays an overtly outsized role in financial markets. After all, in spite of the fact that the Federal Reserve has made statements of its intentions to shed its portfolio of those assets that are acquired during the quantitative easing period, which began after the 2008 financial collapse, which has now gone on for nearly a decade and a half, it still holds a whopping $9 trillion worth of securities, or nearly $9 trillion. Now that means that this inversion that was cited last month was perhaps just the result of this artificial interference with the money markets. But perhaps the best reason for harboring some doubts over this inverted yield curve as a predictor for the next recession has more to do with causation versus correlation. As most statisticians are very fond of saying, correlations are easy to find. They're all around us. but causation is much harder to prove. More importantly, would you really want to trust your portfolio to just one economic indicator? After all, some experts believe that the better comparison is to compare the 3-month Treasury yield to the 10-year Treasury yield instead of the 2-year. And of course, this may portend strong economic growth instead of a recession, since that spread appears to be widening. In any event, I'll let you be the judge. Until next time, take care and best wishes.